Stop for a moment and look carefully at what just happened in the silver market, because the latest collapse was not irrational panic, and it was not market failure. It was a macro-driven repricing event that most investors misunderstood in real time. Silver fell more than 6% on COMEX in a single session and nearly 5% on MCX. Gold dropped sharply as well. Mining equities followed the decline, and ETF outflows accelerated across the precious metals complex. Many interpreted this as evidence that safe haven demand had suddenly disappeared. But that interpretation misses the deeper mechanism behind the move. The trigger was clear. The United States announced intensified military action against Iran under Operation Epic Fury. Historically, geopolitical escalation pushes capital toward gold and silver. Yet this time, the opposite occurred. Precious metals weakened while the US dollar surged and Treasury yields moved higher. This was not a contradiction. It was a shift in safe haven preference. Markets did not abandon safety. They simply changed what they considered safe. Instead of flowing into metals, capital rotated into the dollar and short-duration government debt. That rotation reflects a structural change in how investors interpret inflation risk during geopolitical conflict, especially when energy prices are involved. Oil rising above $100 per barrel changes the entire macro equation. Higher oil prices do not just signal geopolitical tension, they signal inflation persistence. And persistent inflation limits the Federal Reserve's ability to cut interest rates. When rate cut expectations move further into the future, the opportunity cost of holding non-yielding assets like gold and silver increases immediately. That is exactly what happened here. Producer price data reinforced the shift. Core inflation pressures remained elevated. Markets quickly reassessed the timing of policy easing. Instead of anticipating near-term liquidity expansion, investors began preparing for a longer period of restrictive monetary conditions. And restrictive policy environments favor the dollar. This explains why the US dollar index breaking above the psychological 100 level mattered so much. Commodities priced in dollars become more expensive globally when the currency strengthens. But more importantly, the dollar itself begins to function as the primary defensive asset. In previous cycles, gold absorbed geopolitical stress flows first. In this cycle, the dollar did. That distinction is critical. At the same time, Treasury yields continued rising as investors repriced the expected policy path of the Federal Reserve. Higher yields increase the relative attractiveness of government bonds compared with metals. When investors can earn nearly 5% annually in short-term treasuries, holding a volatile, non-yielding asset becomes harder to justify from a portfolio construction perspective. Institutional capital does not ignore opportunity cost. It responds to it immediately. This is why the recent decline in silver should not be interpreted as a collapse of the safe haven narrative. Instead, it reflects a temporary reprioritization within the hierarchy of defensive assets. The dollar strengthened, yields increased, inflation expectations rose, and precious metals adjusted accordingly. Even central bank positioning contributed to the pressure. Reports suggesting that some reserve managers slowed gold purchases removed an important structural layer of support beneath the market. Central banks typically anchor long-term confidence in metals. When their buying activity pauses, sentiment weakens quickly, even if fundamentals remain intact. This does not mean metals have lost their long-term role. It means macro liquidity conditions currently dominate price direction. When the dollar strengthens, yields rise, inflation expectations remain elevated, and policy easing moves further into the future, precious metals rarely outperform in the short term. They consolidate, they correct, and sometimes they fall sharply. That is not market failure. That is macro alignment.
Understanding this alignment is essential because investors who mistake cyclical pressure for structural breakdown often exit positions at exactly the wrong moment. And right now, What appears to be weakness in the precious metals complex may actually be the early stage of a much larger repricing process still unfolding beneath the surface. One of the most confusing signals in the silver market right now is the sharp divergence between physical inventories and paper prices. Many investors see falling inventories in Shanghai and London vault systems and assume that prices must rise immediately. But that assumption misunderstands how commodity pricing actually works in modern financial markets. Low inventory does not control short-term price direction. Liquidity does. Shanghai Futures Exchange inventories recently dropped to roughly 350 tons, close to a decade low and dramatically below the levels seen just a few years ago. London vault holdings also declined. On the surface, that looks like a classic bullish signal. Supply appears constrained. Industrial demand remains strong. Renewable energy adoption continues expanding. Electronics manufacturing still depends heavily on silver. So why did prices fall instead of rising? Because futures markets set price discovery, not warehouses. Silver pricing today is dominated by leveraged positioning, ETF flows, currency strength, yield expectations, and macro sentiment, not immediate physical availability. Institutional traders respond first to interest rate expectations and currency moves. Physical scarcity only begins to dominate pricing once it reaches a level that threatens delivery confidence. We are not there yet. This distinction is critical. Paper markets operate on positioning speed. Physical markets operate on supply friction. And those two forces often move in opposite directions for extended periods before eventually converging. Right now, macro positioning is overwhelming physical tightness. A strengthening dollar reduces global commodity demand. Rising Treasury yields increase the opportunity cost of holding metals. Inflation driven by higher energy prices delays Federal Reserve easing. Together, these forces create downward pressure even while inventories decline. This is not a contradiction. It is a sequencing effect. First, macro adjusts, then positioning adjusts. Only later does physical scarcity assert pricing dominance. Investors who expect inventory tightness to immediately override macro conditions often enter too early and absorb unnecessary volatility. Markets rarely reward impatience during transitional phases like this one. Another important factor is industrial demand elasticity. Unlike gold, which is primarily held as a monetary reserve asset, silver has a dual identity. It behaves both as a precious metal and as an industrial input. That dual role changes how price responds to tightening supply conditions. When macro conditions weaken manufacturing expectations globally, industrial metals rarely rally immediately, even if inventories fall. Instead, markets wait for confirmation that demand remains resilient despite higher financing costs and slower growth expectations. That confirmation has not fully arrived yet. Yes, solar expansion continues. Yes, electronics demand remains stable. Yes, renewable infrastructure still requires silver-intensive components. But capital markets are forward-looking. They price expectations, not current shortages. And right now, expectations are being shaped more by interest rates than by inventory levels. This is why divergence between paper selling and physical tightening can persist longer than most investors anticipate. However, divergence does not last forever. Historically, when physical inventories remain structurally tight while speculative positioning becomes excessively bearish, the adjustment phase tends to be abrupt rather than gradual. Prices do not slowly recover. They reprice quickly once delivery confidence becomes a concern. That is the stage sophisticated investors monitor carefully. Because the most important signal is not inventory decline itself. It is the interaction between inventory decline and positioning exhaustion. When leveraged shorts begin covering while inventories remain constrained, volatility shifts direction rapidly. And that is exactly the type of setup that often precedes the next major move in the precious metals cycle. Understanding this timing difference between macro pressure and physical scarcity is what separates reactive traders from strategic investors.
One of the most misunderstood indicators in the precious metals market right now is the gold-silver ratio. Many investors see silver underperforming gold and assume that it confirms structural weakness. In reality, the opposite may be true. Relative underperformance often signals emerging opportunity. The gold-silver ratio is currently sitting in the mid-60s. That means it takes roughly 65 ounces of silver to purchase 1 ounce of gold. Historically, when this ratio expands beyond equilibrium ranges, silver tends to outperform during the next upward phase of the commodity cycle. This does not happen immediately, but it happens consistently. Silver's recent decline from its January highs near triple-digit levels down toward the low 70s created the impression that the metal is losing its momentum advantage. Yet, when measured relative to gold rather than in isolation, the picture changes significantly. Gold corrected, but silver corrected more aggressively. That shift widened the ratio and created a relative value imbalance that long-term commodity investors typically watch very closely. Relative value matters more than headline price direction. Because institutional capital rarely allocates based on absolute price alone, it allocates based on comparative positioning across asset classes. When silver becomes cheaper relative to gold, while physical supply remains tight and industrial demand remains structurally supported, the probability of future outperformance increases. Not certainty, but probability. This is where timing becomes critical. Markets rarely rotate into silver first. They rotate into gold first, then move into silver once confidence in the metals cycle strengthens. That sequencing has repeated across multiple commodity expansions over the past several decades. Gold stabilizes sentiment, silver amplifies momentum. And right now, the ratio suggests that silver is entering the stage where amplification potential begins to build. Another important signal supporting this interpretation comes from positioning data rather than price data. Open interest in silver futures recently increased while price declined. At first glance, that looks bearish. Rising open interest during falling prices usually indicates that new short positions are entering the market rather than existing longs exiting. And in the short term, that interpretation is correct, but positioning signals are rarely one-dimensional. When markets accumulate large short exposure during periods of declining inventory and persistent industrial demand, they also create the conditions necessary for future short covering rallies. The same positioning pressure that pushes price downward can later accelerate price upward once sentiment shifts. This is the paradox of leverage-driven markets. Short interest creates downside momentum first, then it creates upside fuel later. What matters is not simply whether open interest rises or falls. What matters is whether positioning becomes crowded relative to macro catalysts. When too many traders align on the same directional expectation, the probability of reversal increases sharply once the narrative changes. And silver markets historically react violently when positioning begins to unwind. This is why technical support levels near the psychologically important $70 region on COMEX matter more than they appear on the surface. If support holds while short positioning continues building, the probability of a positioning squeeze increases. If support breaks decisively, the market resets expectations lower before rebuilding accumulation. Both outcomes are part of the same cycle. Neither outcome invalidates the longer-term relative value argument implied by the gold-silver ratio. Because relative value signals operate on a different timeline than positioning signals. Short-term positioning explains volatility. Medium-term ratio behavior explains opportunity.
And investors who understand how those two signals interact are better prepared to recognize when apparent weakness is actually the early stage of a structural rotation still developing beneath the surface of the metals market.
Whenever precious metals fall sharply during periods of geopolitical tension, one explanation immediately dominates public discussion: manipulation. But markets rarely need conspiracy theories to explain volatility. They need macro context. The recent decline in silver occurred during a period when the US dollar strengthened above the key 100 level. Treasury yields moved higher, oil prices surged beyond triple digits, and expectations for Federal Reserve rate cuts shifted further into the future. That combination alone is historically sufficient to pressure non-yielding assets like silver and gold. This was not an anomaly. It was alignment. When inflation expectations rise because energy prices move higher, the Federal Reserve cannot ease policy quickly without risking further inflation acceleration. And when rate cuts move further away, real yields stabilize or rise. That increases the opportunity cost of holding metals and strengthens demand for dollar-denominated assets. Capital follows yield before it follows narrative. That is exactly what happened. At the same time, global investors rotated toward short-duration treasuries as a defensive positioning strategy. In previous cycles, gold captured that defensive allocation first. In this cycle, the dollar captured it instead. That shift created the impression that metals had suddenly lost their safe haven status. They did not lose it. They temporarily shared it. And that distinction matters because safe haven leadership rotates depending on inflation conditions, policy expectations, and liquidity availability. Meanwhile, the physical silver market continues signaling a very different message beneath the surface. Inventories remain tight. Industrial demand from electronics, solar infrastructure, and renewable energy expansion continues supporting structural consumption. Delivery pressure across major exchanges has not disappeared. It has simply been overshadowed by macro positioning flows. Paper markets dominate price direction in the short term. Physical markets dominate price direction in the long term. The tension between those two forces is what defines the current environment. From a strategic perspective, investors should not be asking whether silver is bullish or bearish right now. They should be asking which macro variable will move first. If the dollar continues strengthening toward the next resistance zone above 102, additional downside pressure on metals remains possible. If Treasury yields continue rising, positioning stress inside leveraged futures markets may persist. If oil remains elevated, inflation expectations will continue delaying policy easing. Those conditions extend volatility, but they do not eliminate opportunity. Because the alternative scenario remains equally plausible. If the dollar stabilizes near current levels, if yields begin flattening, or if geopolitical developments reduce energy-driven inflation pressure, sentiment can shift quickly. When sentiment shifts while inventories remain tight, repricing events tend to happen faster than expected. That is how commodity reversals typically begin. A third scenario is even more likely in transitional macro environments like this one: extended volatility without immediate resolution. Silver may trade inside a wide range while macro signals compete for dominance. During those phases, markets are not choosing direction. They are building positioning. And positioning phases are where long-term opportunities are usually created. This is why experienced investors rarely attempt to identify exact bottoms in metal cycles. Instead, they monitor the interaction between currency strength, yield direction, inventory behavior, and positioning data. When those signals begin aligning again, the next directional move becomes clearer. Right now, alignment has not returned yet, but the divergence between macro pressure and physical tightness suggests that when it does return, the adjustment may be stronger than most investors expect.